Okay, hello everybody. Welcome to Korean Atlanta Mentorship. In this video, we're going to talk about maximizing your success with Velocity Banking and understanding which tools to use. Normally, when Velocity Banking is taught at a very, very, very beginner level, people talk about, oh, you should use either a personal or a home equity line of credit. And in my opinion, and I've heard other people talk about this too, you would want to use both credit cards and a personal home equity line of credit. We're just do a quick terminology review. So, what is a line of credit? All it is a financial product or tool where you could borrow money, pay it back, and use it over and over again. So that is the opposite of a loan, which is a one-way street. Loans usually have lower interest rates, but if you overpay a loan, right? You overpay a loan, you can't get that money back. So, for example, if the student loan payment is $400 a month and you pay 500 and you have a $100 emergency, you can't call the student loan company and say, "Hey, I want my $100 back," right? This is why lines of credit have higher interest rates, just like with any other product. If a software product has more features, they make you pay for it than maybe like a base or free version, right? Same thing in the financial or lending world. Okay. Now, there's two types of lines of credit, or I will put them in two categories, right? So a credit card is definitely a line of credit, and so is a personal and home equity line of credit. And the reason I categorize these in the same bucket is because, in my opinion, the only difference between a personal and a home equity line of credit is that one requires, for sure, requires collateral, right? When you have a home equity line of credit, you're putting your home equity as collateral. Therefore, they're going to give you a line of credit based on that, and they have different features, right? Let's just list why we would want to use both of these tools when doing velocity banking. So I'm going to list the benefits of using um, a personal or home equity line of credit. And the first benefit is lower interest rates, right? So I remember I talked to somebody a few days ago, and she said she had a home equity line of credit at 5%. It's like you got to give me some of that because I have 10% right now, but it's lower interest rates compared to, let's say, credit cards, right? So right now I have a personal line of credit, so I'll just put personal at 15% interest, right? And then I have a HELOC or home equity line of credit at 10% interest. Now, these are variable, but I'm just kind of giving you the averages of what those interest rates are. So, if you're transferring a credit card to, let's say, a home equity line of credit, you definitely are going to win by taking advantage of the lower interest rates. But the only downside is, especially with the home equity line of credit, is that you're putting your home equity as collateral. So if you don't pay it back, obviously, the person who's issuing that home equity line of credit has the right to foreclose. Although for most practical purposes, most people who do lend or institutions do lend, they want to do everything that they can to not foreclose on the home, right? All right. So now that's pretty much one of the biggest benefits. And what's the second biggest benefit? Or not, I wouldn't say the second, but what's an additional big benefit of having a personal home equity line of credit? The next one, right? The next benefit is that you can use it to pay anything, right? So you can use it to pay loans, you can use it to pay the same minimum payment of a home equity line of credit. So let's say I borrow $1,000 from one of these two lines of credit, and the minimum payment's like, I don't know, $100. I could just borrow another extra $100 from that line of credit, given that there's more to borrow, and then pay it with that same line of credit. Like you can't pay one credit card with another credit card unless you do a balance transfer, nor can you pay like one the same money from one credit card and pay itself, right? Like that doesn't exist. But that would be crazy if I wonder what would happen if that were possible. If people would just like rack up debt to the T if credit cards allowed that, right? Now, again, you can use it to pay anything, including the minimum payment for that line of credit. Okay, this feature is not available on credit cards. So if you ever try to pay a loan with a credit card, that's very hard, and you'd have to use a service like Plastique.com. Or actually, it's actually plastic with a Q, but I like calling it Plastique. And they may charge you a 3% fee, right? But the good thing about that service is that even though they charge you, let's say, like almost a 3% fee, you could still probably get it back with if you have a good rewards point system with the credit card, right? So these are the two big benefits of using a personal home equity line of credit. Now, what are the disadvantages, right? So disadvantages of using a personal home equity line of credit. Um, you pay interest when you pull out money, right? So I've never seen a personal home equity line of credit that gave you rewards for using it. And I think because again, everything there's trade-offs with everything. I think because you can use it to pay off anything, they never have rewards points or systems with personal home equity lines of credit. And the other thing too, again, another disadvantage is that you pay interest when you pull out the money, right? I don't know if they charge it the same day or the next day, but if I use a home equity line of credit to pay my electric bill, I'm accruing interest on that day or the next day, right? And so that is kind of the biggest disadvantage. And so the benefits that are, I'm sorry, the disadvantages that a personal home equity line of credit has is actually kind of like the benefit that a credit card has. And I'll talk to you what I mean by that, or explain to you what I mean by that, right? So let's go over the advantages of a credit card, okay? So let's just go over the benefit or the advantages. And the biggest advantage that I think credit cards have is that no interest is accrued if you pay previous statement in full. So again, check with the terms and conditions of your credit card company, but I've never really encountered a credit card company where if you pretty much pay it off in full every single month, you don't accrue interest. And the next benefit is that you can accrue points and rewards, right? And so if you don't accrue interest, if it's paid off in full, you can pretty much delay the interest on what you would normally pay on a line of credit. So let's say I have to pay the electric bill for this month. If I pull it out directly from the home equity line of credit, then I'm accruing interest the moment I pull it out of the home equity line of credit. But if I use my credit card first, right? Then the credit card bill is going to probably be due like 1 month from now. Then I use my home equity line of credit to pay that credit card off, right? So it's almost like you're going to delay the interest. So basically, you have potential to delay interest by about a month, right? That's like a huge win so that you can really minimize the interest as you're doing velocity banking, okay? So what's the biggest disadvantage of a credit card, right? You can't so there's two things, right? So high interest rates. So I've seen usually if you have a credit card from certain credit unions, I think they might go as low as 12% to usually 30. So if you're using like a mainstream credit card like Chase, American Express, Discover, they usually have very high interest rates, right? But usually I've seen in the credit union credit cards that they don't charge that much compared to the other mainstream credit cards. But that's one. So high interest rates. And then the second biggest disadvantage, I'm sorry, I don't know, I'm coughing. Second biggest disadvantage of a credit card is you can't pay everything with a credit card, right? Like it's not possible or it's very hard. So if I want to pay a loan with the credit card or my mortgage, again, I have to kind of do a little bit of work to do that. Whereas if I just pay things, my mortgage from a home equity line of credit, I can certainly do that. That's not a problem. Okay, I could just click a button on the website and pay anything I want, including the home equity line of credit minimum payment. Okay, so so that's why, because of these advantages and disadvantages, we're going to use the best of both worlds, right? So I'm just going to show you how I would do this and what the strategy is. So basically, it's going to be pretty much the same thing that we've been doing in every single demonstration. So I'm not going to go over the whole spiel of how you create the spreadsheet. There's a bunch of other videos for that. But what we're going to say is, again, we're going to assume that there's, I don't know, I'm laughing, $35,000 in let's say a personal line of credit, okay? And we're going to transfer these two credit cards there. So if we transfer them, the balances of these two credit cards is, let's see, I think it's 31,000, right? So it's 31,000. So definitely a win there because we're transferring from a higher interest rate to a lower interest rate, and our cash flow is 1786. So let's go ahead and just do a quick demo of how velocity banking would work. So this is going to be I2 plus 1. And then this one is going to be the previous month's balance plus previous month's interest minus your cash flow. Say H2 minus 1786.65, right? So you see this right here, okay? And then we got to calculate the interest, okay? So let's go ahead and average this out and then multiply it by the interest rate, which is 0.15 divided by 12. 15 divided by 12. So this comes from this 15% and divide by 12, so you get the monthly interest rather than the annual. Okay, so now here's the thing. Do I stop using these credit cards? The answer, it depends on you, but for me would be no, right? Because once these credit cards are paid off, what I'm going to do is solely because, again, these credit card expenses are in addition to your general expenses, right? And so what I'm going to do is at this point, because these are zero and the balances are down, I'm just going to use these two credit cards and make sure that they cover my general expenses, meaning that they're only going to be used for things that I can pay with credit cards. So let's say we have food, insurance, gas right here. If I pay my food, insurance, gas with my home equity line of credit, guess what? I'm accruing interest today. So let's say today is like February 24th, right? So February 24th, if I go ahead and use my home equity line of credit to or personal line of credit to pay for these things directly out of my checking account, then I'm accruing interest today. So what I'm going to do is pay for my food, gas, and insurance in February 24th, and then once the bill comes, it could be maybe a month later or 1 or 2 weeks later. We'll just say March 24th. Then I take out that money from that home personal line of credit and then pay this off in full, right? So it's like I'm skipping an interest for my or skipping the interest period for my general expenses by about a month, right? Does that make sense? So basically, I can still use these credit cards, but I just can't. I just make sure that it doesn't pass 1,500, right? Because that's my budget for my general expenses. And the reason why you got these credit card balances, is that you spent over your 1,500 and you accrued debt. So you just have to be a little bit smart. And it doesn't matter if you just use one credit card, two credit cards, but it just you so for example with credit card one I could put 800 here, and then credit card two I could put 700, just as long as it never surpasses my general monthly budget or budget of general expenses um, every single month. So every single month, whether I swipe in credit card one or two, I just have to make sure it equals 1,500, right? As I'm doing my budgeting. And when I do that and use my credit card, again, there's two real benefits to this. One, as long as I pay it off in full, and there's no reason why I wouldn't pay it off in full because I have the budget for it, I'm not going to accrue interest on that credit card. And once I take it from my line of credit, as I'm paying off my other debts, okay, then I'm going to delay the interest, right? And the other thing too is you might get like rewards points and stuff like that. So as you keep using your credit card, you might get little freebies, little bit of cash rewards points. So you might win in that sense too. And that's why I use both. I just don't, I have all. There's a saying that banks don't lend you money when you need it. So I have all these credit cards that I'm constantly using, getting rewards points. I have a home equity line of credit. I'm using all of it, but just as long as I know that it's never my credit expenses are not gonna or credit card expenses are never gonna exceed whatever I have for my general number, and this could also include rent as well. Um, then I'll be good, right? And some might be wondering, like, you can actually pay a credit card with rent. Yes, there are credit cards that actually specialize in paying rent, and the only thing I could think of right now is the Built Mastercard, even though we're not sponsored by them, and maybe I should seek some sponsorships. Okay, so but the basic strategy is the same, right? So the only thing that will change is that this interest figure might actually be lower, but we're just estimating the average daily balance of that and the interest calculation, right? So the average daily balance might actually be lower because you're offsetting the interest potentially by a month. But other than that, so let's just go ahead and copy these formulas. So, right, let's copy them down and see when these credit cards get paid off when we do a simple debt transfer. And so here we see that in month 20, I'm going to get that. We paid off $31,000 of debt. Woohoo! So this got paid off in 20 months. And let me go ahead and draw this. Let me draw a celebration. Woo hoo. You ever see those guys who like use this to do presentations? I have no idea how they do that. Like I can't do that, and I'm pretty terrible at drawing. And I'm going to draw a house and do a real estate. Like I'm going to buy this house and pay off the debt quickly using velocity banking. And the funny thing is, I have no idea how to like erase this effectively. Oh, maybe I do. Okay, all right, great. But as I said before, now you kind of understand that the strategy or the implementation is the same, but you don't have to get rid of your credit cards. You just make sure that they're equal to this general number every time you're swiping every month. Now I know there's a caveat where you know, Dave Ramsey says that the advantage of paying in cash is that you actually get to see the money go out, which is, that's a fair argument, right? But which is why this part requires a little bit of discipline and not you going crazy, or you make so much money, right? That this is my strategy. Make so much money and not have like super refined expensive taste like buying a new truck, right? Because a lot of people do that, and I don't like trucks. That you're gonna come up cash flow positive. That's my strategy. I'm not like super um, disciplined in budgeting, but I don't have too many expenses, or at least I don't think I do, right? But again, this is why you use both tools. You don't just go for the personal home equity line of credit only. I would go for both. I got a 15,000 personal line of credit. I got a 50,000 home equity line of credit. I also have, I think, like 18 credit cards. I know in total I have like $258,000 in lines of credit today, and I probably got to make a video of that, like how I got $258,000 in lines of credit, because I've been making other ones like 248, 240, right? But basically, understand why it's kind of why it's advantageous to use both, right? Especially that you can't pay everything with a credit card, and that's why so many people are at a disadvantage because they know how to get the credit cards, but they're afraid to get like the personal lines of credit, or they don't know where to look, right? All right. So this is a Korean Atlanta mentorship. If you're interested in joining our group and learning about financial literacy and real estate investing, go ahead and click the Google form link below. Happy Saturday. Have a great day, and we'll see you on the next video. Also, one other thing I want to mention, I totally forgot to mention it, is that there's going to be a live stream on Monday. I probably got to do a better job promoting it, but it's going to be based, the topic's going to be on newbie success. So if you want to join that only for YouTube members, so it's 99 cents a month. You get access to emojis and access to the member exclusive live stream. So it's just kind of a little motivation to kind of help you get started with whatever it is that you're trying to do. Again, topics about newbie success. All right. We'll see you all next video. Bye, everybody.